Hi, good afternoon, traders. I've decided to make a forex basic webinar. So basically, this webinar is meant for those newbies who have never traded any financial market before, right? You might be trading the stock market, but all along you might buy your stock based on your broker recommendations, okay? And yet you might not have seen any candlestick chart before, okay? So I strongly suggest any new traders or any newbies who like to attend my intermediate, I should call it, my next workshops, which I call it intermediate to advanced workshop. It's best that you watch this basic webinar for a few times before you actually attend the actual workshops. Okay, let's begin. Now, what is forex? The forex is actually in short form for foreign exchange market, right? Sometimes people call it forex, and sometimes people in short they call it FX, right? And forex market is actually the largest financial market in the world. Now, usually when we talk about the stock exchange, right, the number one stock exchange in the world, right, we would think of is the New York Stock Exchange. Right, New York Stock Exchange, the daily volume, we are talking about 22.4 billions. Right, that is the transaction volume. Right, but for the forex market, now we are talking about $5 trillion. Right, $5 trillion a day. Right, so forex market is big. Is really the biggest market in the world, right? There's no financial market can even come close. If you look at this little green monster, right, it represents the New York stock market, which have a daily volume of 22.4 billions. Now, if you take a look at the forex, now what is the forex? The monster look like? It looks something like this. Can you see that on the left? On the right, the little green monster, which we look at it in the early slide, it looks like it's a very big monster. But now compared to this big, gigantic forex monster, right? This is a 5 trillion daily a day, 5 trillion volume, right? So now, what is the significance about forex, such a big market, right? What is it for us when the market is so big? Okay, now basically is, when the forex market is so big, it basically minimizes the manipulations by the big order trader, right? Imagine when you have a small market, right? When you have a small market, the market will be easily manipulated by those big order trader. Now, I give you an example. Not too long ago, when I met a friend, and then he was telling me that his relative, his uncle actually, right, own a company. Own a company which is listed in the Hong Kong Stock Exchange, and it's a small company which is considered the rest of the listed company. It is a small company. And then he was telling me, you know how these people make money. You know, every day these people are driving the supercar, Lamborghini, Ferrari, you know, roaming here and there, just enjoy life all the way, you know. And what these people do is, making money to them is so easy. They don't really have to work, even though they own a company, but they don't really have to work. What they do is they make money, and now we're not talking about small money. We're talking about big money from the stock market. They manipulate their own company share. Okay, and this is how they do bravely, right? Now they will come. All these shareholder or big deep pocket investor, right, who drive all these fast car, right? They'll meet up and they say, okay, let's example, let's drive this company share down, their own company share down, right? Because the company is small, right? And how they drive the market share down, right? Of course, to the other people, this is insider trading, right? But this is within their means, right? Because the company, a shareholder, they know the inside out what happened to the company. So what they do is they simply fresh out some quarterly report, maybe saying that, okay, well, this quarter the earning is not good compared to the previous, right? So the forecast is not so good. So when they announce such a news, right, to let the public read their company performance, of course the perception of the company is no good. And what will happen to this company share? It drop, right? Now the price drop. So when the price dropped to a certain level, which this group of people, the large pocket, huge or deep pocket investor, think that the price is low enough. So what do? They come in and they start buying. They start by buy the company share at a very low price, right? And they keep their position, and they time themselves when the next earning, or time themselves with another news on another new product launch about the company. Then they'll say that, okay, well, the company is going to I just give it an example, going to launch a new product, and this is going to be an edge in the market, etc., right? So when they leak out such a good news, the company's stock and share, what happened to the price? It goes up. Right? People start to believe that this company is turned around, and they start to do well, and then they start to invest, put money in the stock and share, and that will push the market price up. When the price start to go up, all these people who buy the price at a much lower price, right? They start to unload their positions and start selling to all the retail trader, right? And that's how they make the money. That's how they can buy Lamborghini after Lamborghini, right? And they don't have to work, and they make a lot of money. So when the market is small, it is easily manipulated by all these big deep pocket investors. Now, when the forex market is so big, $5 trillion a day, right? It basically minimizes these kind of manipulations, which is of course only advantage to the institutions and deep pocket trader, and no advantage at all to the retailer, right? So therefore we say that when the forex market is so huge, right, it is good and more fair game, because nobody can actually manipulate the market for too long. All right. Now you can see that this is a chart. On the left bar, the tall bar, the blue color, you can see it's the 5 trillion. Next come along is the 22.4 billion, which is represented by the New York Stock Exchange. Tokyo Stock Exchange stand around 18.9 billion a day. Then followed by the London Stock Exchange, 7.2. Now, if we combine, these are the biggest stock exchange in the world: New York, Tokyo, London. When we combine all these three financial markets, we can't even come close to forex market, right? So it just give you these two slides just give you some idea how big the market we are dealing with, right? Now, what is traded in forex, right? Very simple. Basically, it's money, right? Money is traded. We actually buy and sell money in the forex market. Now, if you are a trader, you say that you want to buy euro, and then automatically the broker will sell for you the other currency, right? Whichever, it could be the US dollar, it could be the pound, it could be the Swiss, it could be the Aussie dollar, whatever, right? So in the forex market, when we say we trade forex, basically we buy and we sell currency, money, right? If you think that particular currency is going up, you buy. And if you think that the other currency is going down, and you sell, that's it. Simple as that, right? It's just like trading, not much different like trading stock, right? Now, trading of forex is just think of you are buying a currency as you buying a share in a particular country. Now, example, when we buy a stock from ABC company, right? That means that we think that ABC company is good, right? And then therefore we want to buy their stock and share. And when we buy their stock and share, basically we are their one of the small shareholder in ABC company. Okay, so now in the currency market, it's exactly the same. When we buy, example, decide to buy yen. Yen is from Japan, right? So if we buy yen, we basically buying into this the Japan's economy. Okay. So in the forex market, when you buy, say, the Japanese yen, you are basically buying a share in the Japanese economy. You are betting that the Japanese economy is doing well, and therefore you will strengthen their currency and go up, right? So you want to buy yen. So when the yen value goes up, and you can sell at a profit. Now the major there are many currencies in the world that we can trade off, right? And these are the four major pairs that we talk about. Whenever we talk to trade a major, right? The euro dollar is one of them. Pound dollar is another second major. Dollar Swiss and the dollar yen. Right? So these are the four major pair of currency we talk about. You can see that the counterpart of euro is dollar. Pound, the counterpart of pound is dollar. It's all dollar, right? The major. Now the other pair of currency that usually commonly traded are the Aussie dollar, New Zealand dollar, right? Dollar Canadians, and some of the cross pair. Those are called the major pair, right? The cross pair will be the euro pound, pound yen, and then you have the euro yen, euro Aussie, pound New Zealand, euro CAD, pound Aussie. Okay, so of course there are more than just these few currency offered, right? It depends on the broker that you have account with, right? Some broker even have more currency, more exotic currency. Like example, they even offer like some of the South America currency, right? And which is very, very seldom that we trade. Okay. Now, forex is a zero-sum game. Now, what do we mean by zero-sum game, right? Because when we talk about zero-sum game, is when one participant lost, right, is another participant gained, right? And in this market, the professional usually, in this market, usually it make up of two group of traders, right? One group is the professional traders. Sometimes we call them smart money. They are usually the bank, institutions, right, hedge fund, etc. Okay. And the other side of the trader is called the retail, right? The retail trader, not the retail professional. Sorry, retail traders. Okay, and retail traders are who are the people who actually belongs to this category. It's people like you and me, right? We are all the retail traders. Now, the characteristic between these two groups is the professional traders. One of the main character, the standout character, is they have unlimited supply of money. Example, bank, they never worry about their supply of money, right? And because of they have unlimited supply of money, they can afford to employ some expert or professionals, smart people, to analyze the market for them. Because of their deep pocket, they are capable of buying equipments, right, or subscribe to informations, or they have the insider. I shouldn't say insider. They have some high intelligence that they can access to certain information that we retail investor we do not have. Okay, right. So now, and then the other one is the other trader is the retail trader. Now, retail trader typically is illiquid. That means that we are undercapitalized, right? Very seldom you see that you see a retail trader can have a couple of $1 million account, right, to trade, right? Most of the retail traders, they start off with a few $1,000s, maybe $5,000 as a starter, right, or even $10,000. Okay, and the smaller newbies, they might even start with $1,000, $2,000, etc. Okay, so you can see that these are the two group of traders that in the market. Now, when we put these two group of traders together, right, and knowing that this is a zero-sum game, the outcome for this kind of made up is very clear, right? The professional will usually end up as a winner in this zero-sum game, and the retail trader will usually end up losing money, right? Mainly because not enough capital, over trading, over leveraging, right? Psychologically, they are not ready as well. Okay, so these are the main reason why we always hear that majority of the retail traders are not making money, right, in the forex market. Okay, and the professional traders, they know how these markets work, and the retail trader doesn't know, because the retail traders will end up always following broker recommendations, friends tips, right, or following some lagging indicators, which when by the time they go in to buy the market, the price is already go up halfway or very, very high already. If the price is already go up very high, how can you expect the price? How much further upwards movement can you expect the price move up, right? So if you follow some kind of lagging indicator, I call lagging indicator because they are indicator come after price, right? So when the price is already move up, and then you see the indicator give you signal to buy, then you go and buy. Usually you end up buying at a high price. Now when you are buying at a high price, how you expect to make money? You can't make money, because when you are buying at a high price, it is time, by the time you get into the position to buy long, it is time the market is about to do a retracement downwards, right? Or before they take another swing back up. Okay. Now, what is lot in the forex? In the stock market, we always say that you buy in US stock, we always say that you buy 100, minimum is 100 share, right? In Singapore, we talk 1,000 share. Okay, I don't know about in Vietnam, by another country, but basically when we talk about forex, we are talking about the forex being traded in lots, right? And in the forex market, they basically have a few different kind of account, right? Of course, the professional account will be we call it standard account, which represent every one time you buy or sell one lot, it is equivalent to 100,000 shares of currency, right? Then the next in line will be the mini account, right? When you have open a mini account, every time you buy or you sell one lot, it represents 10,000 worth of currency. The next in line with the micro, every time you buy or you sell one lot, it represents 1,000 worth of currency. The smallest one, right, will be the nano, right, which is every time you buy or sell one lot, it equivalents to 100 worth of currency, right? Of course, not many broker will offer the nano lots, because to them it doesn't make any sense for them to offer such a small account, because they don't make money from you. Okay, and most of the broker will offer micro, mini, or standard, right? So now what is pip value? We always talk about pip value, right? 1 pip, 2 pips, 10 pips, 100 pips, 200 pips. Now what is pip value actually, right? Pip value is something like in the currency market, right? The currency is being priced at the 5-digit. Example, the euro dollar, we just take example, is 1.1100 example, right? So the last digit, right, let's say from 1.1100, right, and you jump up to 1.1120, right? So you actually, there's a movement of 10 pips. Now, so if the market moves 10 pips, how much is it roughly equivalent, like in dollar sign, in dollar value, I mean, right? So 1 pip in a standard account is more or less equivalent to $10 US, right? In a standard account, standard lot, right? So when you say that the euro dollar has moved 20 pips, it means that 20 pips multiply $10 per pips. The euro dollar have moved $200, right? In that dollar, in the values, in the money value, right? $200. Now, and if you buy one lot, thinking that euro dollar will go up, right? And then the market really move in the directions that you anticipated, right? And the market move like 200, right? You buy one lot, you make $200. Okay. Now, if you put in example 2 lot at $200, and so you just multiply. Okay. Now, what is the leverage, right? You are probably wondering, how come a small investor like us, right, can trade such a high value? Like example, we talk about one standard lot is equivalent to 100,000 equivalents, right? How many traders actually have 100,000 physically deposit into their broker? Not many. Okay. Now, so if you trade, let's say a few lot, 5 lot, that means you are trading 500,000, $500,000. How many people have $500,000 deposit into the account? There are, but not many, right? The common retail traders who just learn how to trade, usually they won't start with the kind of money. So now you'll be wondering, if I don't have the kind of money, how can I then trade such a big account? Okay, so the good thing about this forex is the broker actually lend you the money in that sense, right? You don't actually lend you the money, but because they have this mechanism which in place we call the leverage. Now let's say that you open a account with a broker, and the broker offer you 1:100 leverage. Okay, 1:100 leverage. That means that in order for you to trade one standard lot, right, you no longer need to have 100,000 in your account, right? And if with a leverage of 1:100, all you need is, in order to trade one standard lot equivalent of 100,000, all you need is just $1,000. Alright, because you are talking about 1:100, you just need to have $1,000 in your account, right? You are actually can trade, buy or sell one standard lot. But the thing is, with only $1,000, you are not able to do any buy or sell on one standard, because the broker will, in order for them to lend you the money, so-called, right, they have to earmark 1% in your trade from the money in your trading account as a kind of good faith money, right? So example, if you're going to buy one lot euro dollar which worth 100,000, what the broker need is 1% from you as a good faith money. So 100,000, 1%, or 1% of 100,000 is actually $1,000. So the $1,000 that in your account that you were not able to use it to buy or sell to offset any floating loss that you might have, right? So in order for you to trade, buy or sell one standard lot, your trading account must definitely more than $1,000, because the $1,000 you cannot touch. It's a good faith money that the broker need you to say, okay, in order for you to trade the 100,000 worth of currency, the minimum you need to give me is the minimum you need to put you need to have the money in your account is $1,000, right? So if let's say that you have $5,000 in your account and you buy one lot euro dollar, so out of the $5,000, $1,000 will be reserved as a good faith money, will be put aside, right? So now you have $4,000 as a free margin to buy additional currency pair if you like to, right? Or you can, if you don't like to buy an additional currency, you can use the available free margin to offset any potential loss, right, you might have. We call it floating loss, paper loss. Why paper loss? Because as long as you never close your position, it's just a paper loss, right? It's a floating loss. It's not a realized loss. So you can use your balance 4,000 to offset any loss, right? Now let's say assuming that the market really move your directions and you make the money and you decide to close your position. So you close your positions and you make a profit, or let's say $500. Once your position is closed, right, the broker will unlock or release back the $1,000 as a good faith money back to your account. That means that your account right now will be $4,000 plus your own 1%, $1,000, plus the profit. Let's say you make a profit of $500 that you on the trade. So you will have, your account will become 4,000 plus 1,000 plus the $500, which is $5,500, right? And when in the future you decide to buy or to sell at 2 lots, example this time, the broker will need $2,000 to set aside. So now your floating, your free margin will become what? $3,500, right? For you to offset any loss that you might have. Okay? So because of the leverage, right? That means that people, small investor with small little money or account is able to buy or sell in the currency market. Okay? Because of the leverage. Okay, so this time I talk about just now, example, you have what, $10,000 in your trading account, and if you expect the euro dollar to move higher, so you buy 2 lot, example, at 1.2350. So when you buy, sorry, 2 lots, not here, what 2 lot, 1 lot, I think there's a typo mistake there. When you buy 2 lots, right, with a leverage of 1:100, your broker will reserve 2,000, right, in your trading account, in the money in your trading account. They put aside as a good faith money, as a 1% margin, right? So that your account balance, which is a free margin, we call it, become what? 3,000. Okay, because you have 5,000. Sorry, why 10,000 now become? It's very confusing. Here, I think. It's a bad example here. It's actually all wrong, right? If you have a trading account of $10,000 and you buy 2 lots, right? Basically 2,000 is being reserved as a good faith money. Your free margin is actually 8,000, right? Forget about 4,000, forget about 3,000. It's all wrong, right? It's some error there which I have to change it. Okay, so now you have free margin of 8,000 to buy or sell whichever additional pair, or you can use the 8,000 as to offset any potential loss. Okay. Now, let's say that you never put stop loss. Okay, and the pair that you buy, it didn't go the direction you want, and it work and it go against you, and you have a loss. You have a floating loss, right? So out of the 10,000 that you have, 2,000 are being reserved as a good faith money. So you balance the free margin is 8,000. And let's say assuming the market has actually go down so much that your free margin from 8,000 is slowly reduced to 7,000, 6,000, 5,000, all the way to 0, right? When your account do not have any more free margin, by additional move of 1 pips, right, you will have a margin call. That means that once you do not have any more free margin in your account, right, and the price continue to work against you, the broker will automatically close your open account. This is to protect you and also to protect themselves, right, from any further loss, right? So this is also what we call the free margin call. Now, once your position has been closed because of the margin call, then the broker will release the 2,000, right, which is being reserved as a good faith money. Now your account become, instead of 0, you still have, go back $2,000. Okay, that's how it works. How we make money in forex? Very easy, right? So if, example, the market is trading at 1.20340, and you think that this currency is going up, so you buy. So you buy 1 lot at 20340. So let's say the market really, as what you are predicted, it goes up. It goes up to the price of 2.0895, and you decide to take profit. So you can see that you actually make 555 pips, right? So in a standard account, 1 pip is equivalent to about $10 US, and you buy 1 lot, so you actually profit 5,550. So in the forex market, we talk about when the price is low, right? In order for you to profit, you must buy as low as possible, and as the price move up higher, you take profit. Okay, so we buy low, sell high, similar to stock. Okay, now what different from normal stock trading, right, is in the forex market, you can also sell and make market, right? In the stock market, you can only buy as the stock market goes up, then you sell for a profit. Now, in the currency market, right, you have this additional way of making money. That is, if you think that the euro dollar is moving down, euro is getting weak, right? And let's say the euro dollar right now is pricing at 1.1660, and you think that there's a potential euro is going to move down further due to maybe say quantitative easy, the QE, right? The euro zone is going to print more money, etc. Right? So if that is going to weaken the value of the euro, so you said, okay, I want to sell one lot euro at the price of 1.1660. So let's say the price as what you have predicted correctly, the price of euro dollar moved down. It moved down to 1.1160. Okay, 1.1160. So you actually make how many pips? 500 pips, right? You actually make 500 pips. So 500 pips, again, you multiply $10 per pips. If you sell one lot, you make $5,000 US. Okay, so that's how you can make money in the currency market. You can buy low, sell high, or you can sell high, and in the future when the market moves lower, you buy back at lower price and you make the profit in between. All right. Okay, how can we make money in the currency market? We buy low and sell high in the future when the price moves higher, and we can also sell high at a high price right now, and then anticipating the market will move lower, right? So in the future, if the market really move lower, we then go to the market and buy back at a lower price, right? So the difference will be our profit. Okay. Now, buy sell order, right? Basically, we talk about buy and we talk about sell, right? So of course, in the currency market, there's always two price, right? We call it bid and asking price. You can see that this example on the screen, 1.1225, that is the bid price, right? And the other price is 1.1228. That is the asking price. Okay, just as the money changes, right? When you go to the money changer, let's say you need to go to US, and so you need to change some US dollar, right? When you go there, you need the US dollar. You can't use your Singapore dollar to buy things over there. So you go to the money changer and say, okay, look, I want to buy some US dollar, and the money changer, okay, the exchange rate for US dollar to Sing is 1.2 example, 1.2200 example. So you change your currency to US dollar. The next moment, the next 1 second or 1 minute, you decide to change it back, the money changer will not give you the same rate, right? They'll give you a different rate, because that's where their commission or the profit is, right? So in the forex, it's the same actually. You can see there are two exchange rate there, right? Bid and ask price, and there's a difference of three pips, right? These three pips, which is what we call the spread, right? The broker basically make their profit from the spread, right? Whenever you buy or sell, there's a spread. Okay, just as money changer. In the forex market, you do not pay commissions, right? Unlike the stock market, every time you buy, you have to pay commission to the broker. In the forex market, you don't pay commissions, right? The broker make money from the spread. Okay. Now, whenever you buy something, buy a currency, you always buy at the asking price, right? Somebody own a currency and asking for a certain price. So when you want to buy from it, you buying at the asking price. Now, when you want to sell, you then sell at the bid price. Okay, so the bid price is the first one, and then the asking price is the second. Okay. Order type. Basically, there are three type of order, right? The first one we talk about is a market order. Now, what is a market order? Market order is basically you place your order at whatever market price, at whatever current price which is showing right now on the screen. So we call market price. The next one is called limit order. Okay. Now, what is a limit order? Limit order is let's say example, you anticipate the euro dollar is going to move up, and the euro dollar right now is pricing at 1.2020, but you talk to yourself and say, oh, well, I'm not going to buy at the current price 1.2020. I want to wait for the price to drop a little bit lower so that I can buy at the lower price, right? Of course, we all want to buy at the lower price. We are not going to buy at the high price. So you say that you put your buy order, buy limit at 1.2000. The current price is 1.2020, right? So you tell yourself that, okay, if the euro dollar can drop by 20 pips to 1.2000, I want to in position to buy one lot, example. So you put your buy limit at 1.2020. So the difference between the market order and the limit order is what? The limit order, you are telling the broker that, look, I only want to get into the position at the price that I want. But when you put the market order, you're basically telling the broker is that I don't care what's the price right now, I want to buy right now. Okay, so when you put the market order, sometimes you might not get at the price that you want. The market, the screen might shows you 1.2020. So you say, I buy at the market right now at 1.2020. Your order might not get filled at 1.2020. When by the time that your order get filled, you might see that your order get filled at 1.2025, example. So there's a slippage of 5 pips, right? Slippage of 5 pips, right? So usually when you put in your market order, it does not guarantee that you will get filled at the price that you want. Okay. Now the third one is called stop order. Stop order and the market order is basically the same, right? Basically, stop order is actually a market order. Now, stop order is something like this. So now, let's say, example, you are looking at your chart and say you're saying that, okay, now the current price is 1.2020 again, and you tell yourself, if this price can go above, you want to buy. But if let's say, example, you want to buy this currency, and but you do not want to buy at the current price. You say that if the price can move up higher than 1.2030, you want to buy, right? So what you can do is you put a buy stop at 1.2030. So if the price really moves to 1.2030, right, and then you will trigger your buy order. Okay, so basically these are the 3 types of order that you have to know. Now next we talk about candlestick. What is a candlestick? Now when you come to our class, come to my class, basically I train you to become a technical trader. Technical trader, basically we look at the candlestick charts, right? The historical candlestick chart, and we analyze and anticipate the future price movement, right? So you need to know the candlestick chart. The candlestick, every candlestick represents what? What does it mean? Why is a green candle? Why is a red candle? And things like that. Okay. So every candlestick, basically, it displays 4 informations, right? The open, high, low, close. You can see on the screen, right? Now, why sometimes we have a green candle? Why sometimes we have a red candle? Now, we will have a green candle when our closing price is above the opening price. So you can see, right, the closing price over here is above the opening price. Therefore, we have a green candle. Green candle usually represent bullish. Okay. Now, when we have a closing price which is below the opening price, you can see this example on the right. The closing price is below the opening price. Then we will usually end up with a red candle. Red candle represent bearish market. Okay. So basically, every single candlestick have these 4 information: open, high, low, close, and it can happen to different time frame. Every candlestick will have a different can happen on different time frame. It can be a 1 minute chart, you can be 1 month chart, it can be 1 day, it can be 1 hour chart, right? So it basically say that when you are in a 1 hour time frame, it basically shows you every candlestick represent 1 hour of trading activities. When you are in the monthly time frame, every candlestick represent 1 month of trading activities. Alright, simple. Next, we're going to talk about some of the basic candlestick pattern. Okay, like I say again, when you attend my seminar, you are being trained to become a technical trader. You look at the chart, you look at the candlesticks, and you can anticipate what is the future price. It's going to move up, it's going to move down, and then you take a position accordingly, right? So these are some of the basic candlestick patterns. Of course, there are more, but these are just some of them, okay? Now let's start from this top left, right? These are all the doji. Now what is a doji? D-O-J-Y, J-I, sorry. Doji candle is basically, you can see the opening price and the closing price. Basically, they are at the same level where there is no body. Now, what is a body? You can see this is a red body, and this is a green body, right? This is what we call the candlestick body. This is a green body followed by a red body, right? So, we will consider a doji when the opening price and the closing price is exact same price level. When we have this exact same price level, we will not able to see any candle body. You will just like a cross. Okay, so these are called the doji and loji candle. Next, we're going to see a bearish engulfing, right, and a bullish engulfing. And let's say the price is dropping down, and see a red candle. The next candle, you see a big green candle, right? It totally engulfed the previous candle on the left, right? This is called the bullish engulfing, where we expect price to move upwards. The next one, B, is bearish engulfing. Basically, price is in the uptrend up to a certain level. Then next candle become a red candle, big red candle, and it totally engulfed the previous candle on the left. Right? This is called the bearish engulfing, and we expect future price to move downwards. Okay, so you can see that for there are some more like harami, where you have a big red candle followed by a small little narrow candle, which is actually within the previous candle. This is called bearish harami and bullish harami. Okay, the first one, 3A on the left, is the bullish harami, because you have a red candle followed by a green candle. Red candle meaning bearish, green candle meaning bullish. Okay, the next one on the right, 3B, is a bearish and harami. Okay, then we have the kickers, which we don't really use it a lot. The next one is a dark cloud cover, right, where we can see that we might be in a downtrend coming down. Let's say we are in a downtrend, and the price coming down to a certain price level, that we see a downtrend, right? Sorry, uptrend. Dark cloud cover is uptrend. Let's say we are in an uptrend, and the price coming to a certain price level, that we see a green candle first. Right, after this green candle, the next candle give us a red candle, right? Now, the characteristic of a dark cloud cover is bearish, right? The characteristic is, you can see this green candle, the closing price is here. The next candle, we actually have a jump up and open up higher. So we call this gap, right? It doesn't open immediately on the next candle, open on the same level, but it gap up. Right, so the price gap up open, but finally when this candle closed, it closed lower than the previous candle 50%. Right, so this is called the dark cloud cover, and we expect future price to move downwards. Right, so the opposite for dark cloud cover is piercing. Basically, we are in a downtrend. You see red candle, then we see a green candle, which we have a gap down. See the closing price is here. Then the next candle, the open at the gap down, which is here, right? And by the end of this candle, you can see the price actually rally up, and it closed at the high, and which is also closed at 50% above the previous red candle, right? So this is a bullish sign that indicate the future price is likely to move up. Okay, then with the shooting star, hammer, hangman, things like that. Okay, morning star and evening star, which make up of the 3 candle, right? So these are a few candlestick patterns that you need to know, right? Okay. Now let's go into detail on some of the candle, right? This pattern, this is a hammer, we call it, right? This pattern occur at the bottom of a trend or during a downtrend, and it is called a hammer, right? Since it is a hammer out of a bottom, it is a single candlestick pattern that has a long lower shadow, right? Sometimes we call it wick shadow, or wick is the same, or tail. It is a single candle stick pattern that has a long lower shadow and a small body at or very near the top of its candle range, right? So this is a bullish candle. Okay, we expect future price to actually move up. Now this is a bullish engulfing. You can see price is moving down and we see a red candle, and the next candle we see a bullish candle. It totally engulf the previous candle, right? When you see this such a candlestick pattern, this is a reversal pattern, and we expect future price to move up from here. Okay. The next one we have called the I seldom trade this, but harami, right? Some people like to trade this harami. Basically, we see a red candle followed by a narrow candle where the high and the low is totally encompassed by the previous candle. It's harami. Okay. We expect price to move up from here. Okay. Next one is called the what is this? This is a piercing line, right? The opposite of a dark cloud cover. Dark cloud cover is a bearish candlestick pattern, and a piercing line is actually a bullish reversal pattern. Basically, it's the same, that we are in a downtrend downwards, and we see a red candle closing at a low. Next candle, we see the price actually gap down and open here, right? Open here and it make a low, and finally before this candle closed, you can see the buyer actually pushed the price back up and it closed almost at the high, which is more than 50% of the previous candle, right? So when this happens, we call this bullish not engulfing, piercing line, right, which expect price to move up from here. Then the next pattern is make up the three candlestick. This is the star pattern, right? The evening star, right? Evening. This is this is the evening star. Okay. Basically, we see the price is moving down, right? So this formation make up of one red candle, and then we see a doji or small little candle hammer, right? Where sometimes you might see the gap down. That's perfectly all right, right? And the next candle, actually, we have a bullish candle which closed at the high, right? So when we combine these three candles, it's called the morning star. The opposite. These are all for the bearish candle. This is a bearish engulfing. You can see that this candle, the black candle, totally engulfed the previous candle. This is called the bearish engulfing. Okay, and this is the bearish harami, right? Looks something like a pregnant lady. It means that when you see a harami like this, you expect price to move downwards. Okay. Next one is called the dark cloud cover. Right? You can see the price is going up. We see a green candle, then we see a red candle. My market actually gap up and make a high, higher than the previous candle here. But before the end of this candle, you can see the bear or the seller actually sell down the price and he closed it here. So when you see a red candle like this, right, it basically tell us that the closing price is here and the opening price is here. Okay. The opposite for the hammer, this is a hangman, right? It's the same thing. Price is moving up, and then we see an inverted hammer there. It indicates that future price is likely to move downwards. This is the morning star, opposite of the evening star. Okay, make up the three candle. We expect price to move down after this. Okay. Okay, let me take a 3 minutes break, and then we can reassume after this, after break. Okay. How to pause it? Now, how can one know if a country is doing well in its economy or not? Okay. Now, like just now we say, when you buy a currency or you sell a currency, it's as if that you are buying a piece of the country economy, right? And obviously, if you want to buy a piece of the country economy, you must know that the country economy is doing well, therefore you want to invest in their country. Okay, so how can we know the country is doing well or not? In the stock market, right, we can go and take a look at this published P&L, past P&L, and things like that, right? So when you deal with the currency, right, you can actually know the country economy by looking at some of the reports that that particular government will release, right? Either they do it monthly, quarterly, half yearly, and things like that. They will release it out, right, and make it accessible to the public. And these are the following few of indicators, or not indicators, reports, right, or data that tells whether the country economy is doing well or not. The first one is the Consumer Price Index, stands for CPI, right, and it basically tells you whether their economy is having inflations or not, right? If we go to the supermarket and most of the price are suddenly become more expensive, right? So it basically, right now the money is getting smaller, right? In order to buy the same product off the shelf, right now you have to spend more money to buy the same product, right? This is called inflations, right? So the government, every government, right, from they will send out this kind of report, right? What is the consumer price index? Is it getting higher, or is it within their rate, their target, etc., etc.? Okay. And we, of course, we have the GDP, stand for the gross domestic product, right? Whether their GDP is good or bad, it reflects the country economy. Producer price index, the PPI, right? It basically tells whether the producer in the country are doing well or not. Okay. Then we have the employment situation, right? In another common term we use is non-farm payroll. We basically measure what is the unemployment status or unemployment status in the country. Okay. Obviously, if there are more unemployment, it means that basically the economy is not doing well. Okay. So simple as that. And interest rate announcement by a central bank, which usually they will come. Every central bank, they will come to the market and announce whether they could adjust your interest rate up or down every quarterly, right? So these are informations that we don't have to worry every day. You will do it every quarterly or every monthly, that we already know in advance when the announcement is going to make. And the housing surprise, and then we have the commodity price, trade balance, etc. Okay, you can get all this in this website. I mean, go to Bloomberg.com. You can have quite a very good detail of all the reports that release from period to period. Okay, or if you are lazy to surf the internet, you can actually watch a CNN news, and then sometimes they do announce. Okay, so these are all the reports and data that is we can look at, right, to know whether the country is doing well or not before we decide to invest in the currency. In the forex market, what really matters when it comes to the exchange rate, right? It is basically two things: the market sentiments and the investment climates. Now, what is market sentiment? Example, when a country is facing inflations, there's a fear, there's a risk of inflation. How do you know there's a risk of inflation? How can the central bank or the government know there's a risk of inflation? By monitoring the consumer price index, right? If the consumer price index is getting higher and higher, they know that right now the same dollar they can afford to, they are now buying less same product, right? So when the inflation is getting higher, okay, and the government will have to do something, right, to fight the inflation. Otherwise the people will complain, right? So in order to fight the inflations, one of the common methods that apply by almost every central bank is to use the interest rate, to adjust the interest rate to manage their economy, to combat inflations. When a country or economy is having an inflation, it basically telling indicates that the economy is doing well. That's why. Because the economy is doing well, the business are doing well, making more money, businessmen are making more money, and they are paying more salary or bonus to their workers. So everybody's are having more money to spend, right? When you have a sudden when you have an increase in the buying power, spending power, all the commodity is still, the quantity of supply still remain the same. That means that we have now more people willing to spend on the limited supply of commodity, right? So the price for the commodity will goes up. Okay, the price for commodity will. So in order to fight the inflations, one of the way, very common way applied by the central bank is they increase the interest rate. Right? Why they increase the interest rate? Because when the economy is doing well and there's a risk of inflation. Basically, it is indicate that people are having too much money to spend. So in order to fight inflation, the central bank will increase the interest rate by making the borrowing of money more expensive. Right? Give you an example. Now let's say that you have extra money, and you tend to invest on a second property, third property. Right, because you say right now, okay, my business are doing well, or I'm getting a pay rise from my boss, my bonus is 1 year, things like that. So you want to invest on a second property, okay? But if the government increase the interest rate, that means that it will make your borrowing cost more expensive. Because when you want to invest in a property, you're not going to come out with all the full cash, 100% cash, right? Usually, and very common, people will just put out down payment, certain percentage, and the rest they will get a loan from the bank. So when the government increase the interest rate, that means that for the amount of loan that you borrow, now you have to pay higher interest rate. So it means that the borrowing cost become more expensive. So as a person, you might be second thought that you want to spend on the second property, because right now the borrowing cost is more expensive. Okay, and therefore you might decide to cut back buying the second property and cool off, reduce the demand for the property, and therefore this same concept that can also apply on our daily product that is available on sales on all the supermarket counter, right? So basically, in order to combat the inflations, the government will increase the interest rate to discourage people to spend, to borrow, and therefore to cool off the inflation. Now, when the government increase the interest rate, right, usually their value of their currency will goes up, because more for investor, right, were willing to invest, put their money into this country, right, to enjoy a high interest rate. Okay, so this is called sentiment. That means that when one event lead to another. Now, if you look and people who trade the forex market is a lot of people based on sentiment, right? Before the government increase the interest rate based on the CPI, and they know that there's a risk of the economy running into the inflation, and then let's say the interest rate announcement is around the corner. Let's say this week they're going to make an announcement whether to increase the interest rate or maintain the interest rate, or even reduce the interest rate. By looking at certain economic report, some of these professionals, they already know what kind of policy is about to be announced, the interest rate. So this is called sentiment. So if they think that the government is likely to increase the interest rate, they will actually buy the currency even before the interest rate is being adjusted, because they buy on sentiment. Okay. Now the other thing is the investment climax, right? When the foreign investor, right, will only put their money into a country when the investment climax are good, and then there is no risk of tensions in the country, there is no war in the country, right? So when a foreigner or investor from another country want to invest into want to go to America to invest, as an example, they cannot bring their home currency to buy anything that in America, right? So what they need to do is they need to exchange their home currency or into the American dollar first before they can go into American dollar and go to American and buy some or invest some instrument that they want, right? So in this process, where they exchange or convert their home currency into US dollar, they will create a demand for the US dollar. So when there's a demand for the US dollar, right, and obviously the value for the US dollar goes up. Okay, so the investment climate also affect the currency movement. Okay, how inflation affect the currency, which I just now explained, right? Inflation usually occur during the economic prosperity, and when the economy is good, the business are good, and people have more money to spend. And one of the tools the Federal Reserve used to combat inflation is to manipulate the interest rate, right? Making increase up the interest rate or maintain the interest rate or down the interest rate, right? These are the three things the central bank can do, and they use the interest rate to combat the inflation, right? Now, by up the interest rate, it becomes more attractive for the investor to buy US debts right now, as the US debt is priced in US dollar, and if more investors want to buy US debt, they have to convert their home currency, right, and into US dollar, and therefore that create the demand for the US dollar, and the value of the US dollar goes up. Okay, so increased inflations usually lead to a higher interest rate, and it will strengthen the US dollar, because when there's a risk of inflations, the central bank will increase the interest rate, and by that they will increase the value of the US dollar. Decreasing interest rate means that sometimes you hear the news say, okay, the risk of inflation is getting the risk of inflation is getting lower and lower. So when such a report is being announced, you know that central bank will likely to cut interest rate and or stop increasing interest rate. Let's say previous quarter they have been increasing interest rate to fight inflations. So that when there's a sign that the inflation, the risk of inflation is cooling off, then the central bank is not going to increase the interest rate, right? So by stopping increasing the interest rate or by reducing the interest rate, it also affects the value of the US dollar, right? By decreasing the interest rate, what will happen? It will weaken the US dollar. Okay, so by knowing whether the country economy is doing well, have a risk of inflations, we likely to know what is the central bank will do when they come to the interest rate announcement, and therefore we can anticipate whether the currency is going up or going down, and we take our position accordingly. Buying, selling a currency pair. Currency are trade in pairs, right? For example, Euro and the US dollar, or the British pound and the Japanese yen, pound and yen, right? When you trade in the forex market, you buy or sell in currency pair. Forex trading is a simultaneously buying of one currency and selling a currency. Now, if you take a look at the following major currency pair, Euro dollar. If you think that the Euro dollar is getting higher, so what you do is you buy Euro. The more you buy Euro, your broker will automatically sell the US dollar for you, right? This is how the forex market is being organized and structured, right? So we don't have to worry how I buy one currency and how I sell at the currency at the same time. It sounds very complicated. No, right? It is very easy, right? One, if you think that the euro is going down, it's getting weaker, and you want to sell euro, right? So the more you sell euro, automatically your broker will buy the US dollar for you. Okay, so it's very easy. So the currency always trade in pairs. Okay, when you buy a first currency, automatically you have to sell the second currency. When you decide to sell the first currency, automatically the broker will buy the second currency. Forex market basically trade 24 hours. Why? Why 24 hours? People don't have to sleep. Yeah, no. Yeah, people still have to go to sleep. Now, basically, there are three market, right? The Asian market, European market, and the US market. Now let's start with the Asian market. In the Asian market, we have the New Zealand Auckland, right? We have the Sydney. Then, as the morning open up, we have the Tokyo market opened. Then we have the Hong Kong market opened, Shanghai, of course, Singapore market open. So all these are considered Asian market, right? Asian market. It start at 6. Sydney market open at 6 p.m. Not 6 p.m. Something's wrong. Eastern time. Eastern time. 6 a.m. right? 6 p.m. Eastern time means in Singapore is 6 a.m. It's just the opposite, right? So Sydney market closed at 3 a.m. which means that Eastern time 3 a.m. It means that at 3 p.m. Singapore time the Sydney market closed. The Tokyo market open at 7 p.m. which is Eastern time. So in the Singapore time is 7 a.m. in the morning. The Tokyo market open, right? So they end at 4 a.m. Eastern time, which means that the Tokyo market will close at 4 p.m. Singapore time. So you can see there's an overlapping, right? So then we go to the Euro market, where the Frankfurt market opened at 2 p.m. Singapore time, followed by London market 3 p.m. Okay, so before the one market closed, we already have another market open. So there's an overlapping, right? So even though the market not function 24 hours, individual market don't function 24 hours, but the forex market, because it's overlapping, right, it means that you can go to the market and buy or sell anytime that you want. Okay, it doesn't have to be when the market open. Okay, so anytime of the day, you can always go to the market and buy or sell. Then the next one, of course, the US market, right? New York market open at 8 a.m. which Eastern time, which is 8 p.m. Singapore time, right? And they close at 5 p.m. which is 5 a.m. Singapore time. They close. Now before the US market closed at 5 a.m. Singapore time, you can see that the Asian market already open. Again, there's overlapping. So because of this market overlapping, so they give us this kind of the sense of 24 hours. Okay, you can go to the market anytime to buy and sell any currency, okay, that you think that is going to move. Next one is the support and resistance, right? And this is a very commonly used by many traders. Support, resistance, right? Support is the price level where the buyer overpower the seller, and the price is unable to move further downwards. And the opposite is resistance, right? Resistance is a price level where the seller overpower buyer and the price is unable to move higher. Support is a swing low on the charts, where the resistance is a swing high on the charts. And once these levels are being broken, they tend to become the opposite obstacle. Example, when we have a swing high, which is a resistance, right? So when the price come up to that resistance and it finally break and remove that resistance, okay, that resistance very often in the future, when the price retrace back into this broken resistance again, this resistance will become the future support, right? And that can offer up some trading opportunity as well. Okay, so resistance that is broken often become the future support. Support that is broken often become the future resistance. It's just the opposite, vice versa. Now you can see these are the price swing. You can see that we have a swing high, swing low, swing high, swing low, swing high, swing low, right? So this is a resistance because the price rally up to this point, after which it's not able to move up any more higher, right? And the price dropped to a certain level, you retrace up again, you stop at this level and start to drop again. So this is another resistance. The price dropped to this low, a swing low, and fail to continue move lower because there's a support there are buyer there, and the market start to rally up, right? So these are the swing. Give me a second, sorry. So the swing high and the swing low. The swing high is a resistance, swing low support, resistance, support, resistance, support, resistance, support, resistance, support. Okay. All the swing low are the line of support. Now resistance becomes support, support becomes resistance. Like just how I say, right? When the price make a swing high, right, and it start to move down, at this point swing high, we call this resistance, right? Because at this point we have more seller than the buyer, and the buyer is not able to break above that swing high and it start to retreat. We call this resistance. Okay, so when the price come back again and still not able to remove, and then the price pull back, so once this double top or resistance, once the price come back a second time and it remove this resistance, that resistance very often in the future will become the future support, right? You can see that it used to be a resistance for these two double topped. When the price come back for the third time, it remove that resistance, and once these resistance are removed, right, it become the future support. When the price pull back to this level again, this become the future support where we can expect price to move up. Price come back to the support, move up, come back again, finally move out. Okay, so this is the concept of support become resistance, resistance becomes support, right? It's a concept that used by a lot of traders and it's quite effective, right? So we too want to pay attention how we can make use of this during our advanced course. Okay. The next one is trend, right? Now, what is the uptrend? The uptrend is when we see a series of swing high, swing low, swing high, swing low, swing high, swing low, moving in the same directions, right? So we say that we are in the uptrend. A downtrend is a series of swing high, swing low, lower high, lower low, lower high, lower low, moving in the same directions, right? So this is called downtrend. In the uptrend, market makes higher high and higher low, right? So in an uptrend, you see the market is making a higher high, this high higher than the previous high, and a low higher than the previous low, right? So in an uptrend, the market is making a higher high and higher low. The opposite for the uptrend is downtrend, right? A downtrend is when we see the price making a low, a high, a lower low, a lower high, a lower low, a lower high. Okay? So in the downtrend, we see the price is moving downwards in a series of lower high and lower low. Okay, that's trend. Now, next we're going to some chart continuation pattern. And one of the continuation pattern I want to talk about is this pennant. You can see that the pennant is a consolidation with a converging trend line. See, we have a price dropped and it go into a consolidation. So you can see the price actually goes sideways, making a lower high and higher low, right? When such thing happen, you can actually measure using a trend line to measure the two swing high here, another trend line to measure the two swing low, and you can see it look like the pennant, right? So this is a pole and a pennant, and once the price break to the downside, right, and we're going to see a measure move of the breakout from A to B, which is equivalent to C to D, right? Again, when we see a continuation pattern like this, they will tell us where the future market directions, and we can take actions, take trades accordingly. Okay, so this is the pole of the pennant, and this is the pennant. This is called the bearish pennant. We expect price to move down further, and here we can see a bullish pennant. You can see the price actually goes sideways and it break higher. Once you break higher and overcome these two resistance on the left, you can see the market start to go into the range again one more time, right? So when we wrap two line over it, we see that we have a bullish pennant. It means that once we see the price break out to the upside, and we should see the price rally all the way until it came to this AB equal to CD. That will be our target. Okay, so that's continuation pattern. This is an example of the bearish continuation pattern. We have a pennant, price move down and it go into a consolidations, right? We can draw two lines. Once the price break to the downside, right, the target is actually AB equal to C D, right? We measure from the candle break. Okay. Another chart pattern we will talk about is a flat pattern, right? So just now we talked about a pennant is a continuation pattern. A flat pattern is also a continuation pattern, right? The only difference between a pennant and flat is pennant is a triangle, flat is a rectangle, right? So we see the price dropped and the market goes sideways, making a higher high, higher low, right? Immediately we are able to identify this is a flat, and the pole is pointing upwards. So this is actually a bearish flat. Once the price break this trend line over here, that's indicated by the green dot, we can actually anticipate the market will move down lower, where this point A equal to B here, right, equal to C and D. Okay. So this is a bearish flat, and then we have a bullish flat. Okay, an example for the bearish flat continuation pattern, you can see price dropped and it goes sideways, right? When it goes sideways, it make a low, it make a high, it make a higher low, it make a higher high, and finally when the price break to the downside, right, we wait for price to retrace back up into this supply, right, and the price did that. Okay, so that's an example for the bearish flat continuation pattern. Okay, so here this is the end of my presentation for the Forex Basic. I hope you enjoyed the short webinar, and watch it over a few times and get yourself ready to attend my advanced course. Thank you very much.